Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Okay, good morning, everyone. Welcome to another episode of Sparta Market Outlook. I'm Felipe Elink Schuurman, your host for today, and I'm joined by our special guests, as usual, Neil Crosby. Hi, how are you?
Good, thank you.
To have you here. June Go from Singapore. Hi, June, how are you?
Hi, happy to be back again.
Good to see you. And of course, Jorge Molinero from Madrid. Hi, Jorge, how are you?
Hi, Felipe. All very good. Finally, sun in Madrid after a lot of rain, so very good.
Yeah, I heard. Yeah, apparently it's been a disaster this whole spring. Not as much as a disaster as the market. Let's dive in. So last week, there's no small talk. Let's just go for it. Last week we recorded the pod just before the Liberation Day, and there were all kinds of speculation as to what will happen. And it all really depended on the size and the depth of the tariffs. I have to say that, everyone was sort of expecting, and I think it's still the plan for these tariffs to be the starting point for negotiations. That has always been the plan from Trump and Peter Navarro and Lutnick, etc. It's like, hey, these are the conditions. Now come and see us, and if you come early, you get better conditions. If you come late, you will get worse conditions. Now, what no one really anticipated was, I think, the depth of it. These 45% for Vietnam. That's just one example. And I'm not even talking about the Penguin Islands where there's no people. Let's not get into that. But obviously, the market overreacted. Well, overreacted. I don't know if it's overreaction, but it reacted. Neil, I'll let you go into the details of it. I'm just giving a quick summary, but definitely no one was expecting the depth of it. I still believe that this is only Act 1. We need to see what Act 2 is, which is the general market, the other countries' response. We've seen China responding. We've seen Japan, South Korea responding in the opposite way. But, we're still waiting to see what happens with Europe and other countries, you see. So that's Act 2. And then Act 3 would be, how does the market, or the people in the US react to all of this, when we start seeing prices going up and all that. So I think we have not seen the end of this movie, far from it, which unfortunately in trading environments, it's annoying because what you want is some sort of clarity. But anyway, that's my 2 cents of what happened since last week, since we had a pod. Neil, what do you think? What are your immediate thoughts here?
Yeah, so I think that's a good summary. So, what to say? Yeah, flat prices down $15 since we last spoke, basically. So it's a fairly strong reaction. I think you're right that this is, no one really knows, but this could be the most painful part of it, right? I think what you say is very fair as well. Like, except for China, the reaction has been quite a soft touch from most other countries. And I think there is the general notion that there's not a global willingness to escalate this thing as things stand. But obviously the market this morning is pricing the 104% headline from last night. And it's just extremely volatile right now. So I don't think we should be making any firm statements. But I think what you said in terms of there will be multiple acts to this thing holds true. And I don't know where this all pans out, whether that over the medium term, whether that means for oil demand, it could be negative this year, even if it's a relatively soft rest of the year in terms of tariffs. I don't know. I wanted to go through one plausible scenario. I'm not saying that this is it, but just to remind us of some of the things that could balance the oil market out a bit. This scenario is analogous to COVID, where there's an initial shock and everyone thinks demand is going to plummet. And in COVID, it did temporarily. But then, let's say that the tariff signals get softer and the outright tariffs get over time lowered as the deals get made, and sort of said the outlook starts to improve a bit. And then you've got all the supply side things. OPEC starts to cut, and then they only slowly backfill because that's what they did in COVID as well, let's be honest. And then US producers start to struggle because outright prices are low. China starts to restock its SPR. The US might start restocking SPR. And then you end the year in a much tighter place than prices are currently telling us. That's still possible. I still see that kind of thing as possible. I don't know, but it could be.
Well, that's why, as you said, having that is as possible as the opposite, environment where we end up in a situation where actually we go into a confrontational mode. We haven't really heard from the European Union. Ultimately, let's face it, the 3, 4, 5 countries that really matter are US, Europe, China, Japan, and that, everyone else is sort of like collateral damage in a certain way. I'm talking about, Vietnam and things like that. It's not going to move the needle in financial markets or your general geopolitics, with all the due respect that I have for all of these countries. And don't get me wrong, but we need to see what are the reactions. I think that people have not reacted yet. They're negotiating under the radar, not making noise and all that. We'll see. But this, Europe has clearly stated that they want to negotiate, but at the same time, they're also negotiating with China because they're thinking, well, if China is not exporting anything to the US, then everything's going to be dumped into our backyard, and that's not possible neither. So it's a very complicated situation. And in a way, what Trump has done is he's forced the conflict, forced us to have a conversation that no one really wanted to have. But in a way that in such an abrupt way that it's difficult to actually wrap your head around it, So we need to see, and we need to, let's not forget that the US is a very divided country, and we saw that with the elections. And there's already people in the streets complaining, and there's an impact on the businesses in the US. 70% of everything that you buy in Amazon comes from China. So if suddenly, everything that you buy in the US is now 100% more expensive, and it's 100%, and then you need to add the margin. Generally, margins are on a percentage basis. If it's 15% of 100, it's not the same as 15% of 200. And so on and so forth. So it can be very, very expensive, and we'll see what happens there. Look, what we've seen so far, let's just go back to the basics, is what we've seen is that demand, everyone is anticipating a demand crunch, if you want, as you said. Prices, and let's not forget that OPEC also made quite an announcement at the same time. Maybe you want to describe that as well?
Yeah, well, it was very interesting timing last week. So the OPEC announcement of bringing forward supply. At the time, my initial reaction was, this is proof of some kind of I don't want to call it conspiracy, but like
orchestrated sort of,
effort to take Venezuela off the market and bring back OPEC and all that kind of stuff. Now I just think it was kind of bad timing, to be honest. And I did see some headlines, not confirmed, but that OPEC met again at the weekend, concerned about prices. So maybe that tells you, it's kind of an honest reaction.
Yeah, bad timing. Whether it was orchestrated or not, it was definitely bad timing, and it only exacerbated the reaction of the market. Now, look, what else? What does this mean in the short term? The reality, and this is why, we were just discussing this before we started recording, is what does it actually mean, and what we have seen in the market. Let's try to bring some clarity into what does it mean in the short term, and then the potential scenarios of the midterm, and what we have seen as a market reaction. Let's try to bring some clarity there.
Yeah. Well, before we go into into things like spreads, should we just talk about what's the outlook for flat price this week?
For example,
apart from all the volatility that's possible, it's going to be headline driven. I imagine if there's another reaction from the EU, or you can see that China is being very aggressive back, which is kind of as expected. So I guess this thing gets worse with more headlines. I don't know. And someone I was speaking to this morning was pointing out that flat price TI is approaching the kind of producer put levels. And once you get past that, you start to make this thing worse. So there's that kind of thing on the near term horizon. Of course, I don't know, but yeah, it could get worse. On the physical market, things that we should point out. Time spreads held up remarkably well in crude. And almost everywhere else. Naphtha is maybe one exception, Jorge. So we're still backwardated. We came down from I don't know, plus $1 backward in Brent down to sort of 40, 50 now. Cracks held up remarkably well in things like gas oil. So naphtha is a different story again, but gas oil cracks are unmoved. And so ultimately refining margins are largely unmoved. So the physical market tells us not much has changed. And, that presumably will be status quo until it isn't, until there's more evidence that demand is very much impacted and all that kind of stuff. So, and there's been some east-west movements. So naphtha initially collapsed on the east-west and now it's recovered a bit. Mogas also down. The Dubai market's correcting in the crude market. So that's mostly the spot premiums, I would say. And distillate actually also narrowed. So Asia priced a bit more tightness than Europe, which kind of makes sense. And yeah, so all told, it's not hugely bearish in the physical market yet. Jorge, do you want to continue that and talk about what happened in LPG?
Yeah, first one little comment about what you said. On naphtha, we are seeing a little bit different dynamic because the market was on a downtrend already. We have seen petchem prices, we have talked about it in the podcast, but they have been trending downwards since the middle of February. So the market was not supported on that side. And then all the macroeconomical environment has a very strong impact on naphtha. That's what we have seen, this huge correction on cracks and spreads, mainly in time spreads. We are seeing values close to contango in the second half of the year, and probably it will get worse if the macroeconomic situation does not improve.
Yeah, because before we go into the LPG story, which is obviously a big story, because that's something that really has had an impact, But if we, from what you're saying, Neil, is right now it's a lot of rumor, but really nothing physically, materially has happened. So at least on the oil market, indirectly we will see an impact, like perhaps a demand shock and less demand. So the diesel will have an impact, but right now we have not seen any kind of direct impact other than LPG into China. Correct.
And you could probably attribute the Middle Eastern crude diffs to more OPEC supply, things like that, rather than
more
that
of an
kind of
OPEC strategy. Yeah,
you could. Yeah, no, I think that's fair. So the short-term outlook for that kind of thing, I suppose, is look at what the incoming macro data is doing, look at what spreads are doing, because spreads will give you more of probably the first indicator of if something is drastically wrong in the physical market, right?
Yeah.
So it's going to be wait and see. But just now, you're right. Yeah, nothing has really changed.
Nothing, in theory. I would say that potentially the bigger impact is it's a double whammy on the LPG, because again, not only you cannot import LPG from the US, or you can, but at a much higher price, and it affects LPG, and we'll talk about this in a second, but also petchem production, ultimately plastics and, all of this, which is mostly produced in China, will now suddenly not have one of the homes, because 104% import taxes, forget about it, it's like,
yeah.
So there is a disruption there, which is a direct impact, I would say. So right now, unless I'm mistaken, the only impact I see on a material, reality right now is LPG and petchem,
Yeah.
Other than
yes,
that,
and
am I forgetting something here or not?
No,
I think no.
Don't think so.
And I think that it's an impact on both ways, because China is the biggest importer and they import from US, so the main flow is directly impacted, and also China is the biggest exporter of plastics in the world. So we have both legs of the trade flow impacted by these tariffs.
So LPG, obviously, that is clear. There's a clear bearish trend. I don't know how much of it has been already priced. Let's face it, flat price is very low. And generally speaking, when flat price is low, petchem demand tends to pick up. There is a demand elasticity there. So, how much of it is priced, I don't know. But it is obviously affecting naphtha indirectly, naturally. Other than that, it's a wait and see kind of scenario, because, Neil, you were describing an environment where at these kind of levels, crude production in the US can be, severely impacted, which then has a demand, a supply shock. So you don't want to be too bearish on diesel demand, because you're going to have an impact on the supply from, Yeah, I cannot wrap my head around it right now, on other things than outside of naphtha LPG.
I think it's a wait and see game on diesel, and that's also true of supply. Just to clear that up, I don't think that US shale producers are that responsive. I think the most and fastest response on the supply side will be OPEC, because they have a budget to balance, and I'm not quite sure what the Saudis need for their budget, but it's higher than this, quite a lot higher, and the Russians too. So I think that's the fastest response, and it could well be that we get some comments from OPEC already in the next week or two regarding future strategy. We might get some more comments from Trump regarding Iran and Venezuela. That could be an option. There could be US SPR comments. China might start to restock. There's all kinds of things that might happen. But the US kind of shale production is probably the least, not the least reactive, but not that reactive just now.
Yeah, maybe just to add some numbers on the LPG impact, since we agree it's the main market that is going to be impacted. Yeah, US export to China represents 60% of China imports of LPG, and it's a volume around 0.5 million barrels per day. So it's a very big flow, and is the main supplier for China, which is the main importer in the world. So what we have seen is, after the retaliation of China with a 32% in the tariff, the flat price has collapsed, especially in the east. So the indicator in Asia has lost 30% in a couple sessions. So that's $180 per metric ton, and this has spread in the other markets. It has impacted Northwest Europe and Mont Belvieu flat prices as well. And then the last news we have from yesterday afternoon, or European afternoon, is the immediate response of US with 104%. So we don't have still the final point. It's a debate that is still undergoing, but yeah, the flow is going to be impacted in the very short term, since the tariff from US start today and the tariff from China start tomorrow, 10th of April.
And you mentioned there were 20 cargoes en route right now?
Yeah, exactly. That's one of the key things. There are 20 or more cargoes en route to China, and we have been hearing that they are looking to new places. So they could land into Japan, Korea, maybe India. India used to import from Middle East, but it could be a potential outlet right now without China. Japan, Korea, Taiwan would be the main options, and also we could see it in vessels that are not that are going to load in the short term as well.
Yeah, I mean, I guess that ultimately, at the end of the day, whether you're supplying, the big story here is the fact that China doesn't really know if they want to produce or not these products, these plastics, etc., because there's a massive uncertainty. If the US, I don't know, probably US represents 30% or 25% of everything they sell, suddenly you're like, well, should I be producing those 30% or not? And let's not forget that China is very top down. So maybe China says you should not be selling to the US, or something like that. You see, we don't know yet. So yeah, that is the biggest problem, is that suddenly you've lost for 1 week, 2 weeks, 3 weeks, a month, 3 months, I don't know, 30%, 25% of your production, and therefore of your LPG/naphtha demand. Yeah, that is the story.
Yeah, and that has an impact directly on PDH. So if that happens, we will see lower PDH rates, and some of them going on a turnaround, because the biggest percentage of the demand is propane going to PDH plants. Then there is a part that goes to heating, but the most interesting story would be about PDH rates in the medium term.
Can I just interject? So there's kind of two stories emerging. The one is that LPG, or numerous stories, but from what we discussed yesterday, Jorge, LPG, the global market plummeted, partly on the news, the headlines and stuff like that, but partly because it's also trying to price itself into flex feed crackers elsewhere, right? So if you have the naphtha flat price plummeting, and propane needs to compete with that, as well as on a relative basis compete against naphtha even further, that is a very bearish short-term signal, generally speaking, for propane. And then you had, let's say, a bunch of distressed cargoes already on the water, and what you actually saw over the last 2 days was the spread between US propane and naphtha versus European and Asian propane and naphtha actually narrowed, which is the opposite of what you kind of expect medium term.
Yeah,
Because,
exactly.
because ultimately the loser here is the US propane market. I mean, not long term, maybe because it will get redirected. But that's the kind of thing that you might expect to reverse, right? Because you kind of want LPG from the US to price into the rest of the world by getting cheaper, relatively speaking. Is that fair?
Yeah, no, that is fair. And the expectation for the LPG supply in the US is to grow in the second half of this year. So that gives even more reasons to a potential reversal on the spread between Mont Belvieu and the Asian prices.
But what is the midterm expectation here?
Yeah, so right now what we have seen, well, as Neil have said, we have seen a correction that has been bigger in the Asian market compared to the US alternative mainly. So this has been compensated a little bit by the China cash dips. They have traded higher, but yeah, our expectation is that this trend will reverse on the pricing side. So yeah, as Neil has said, the big loser is Mont Belvieu C5, and then talking about another producers, the big winner could be Middle East, since their main buyer right now it's India. And if China lose US as a supplier, they will need to find some part of the product. Maybe they will reduce the PDH rates and so on, but they will need to find some part of the product in another market. And the one that is closer and in a best position to supply is Middle East. So we could see some support on the CP index, since China could increase their imports from the Middle East.
I think from timing perspective, unfortunately, we were expecting many new crackers coming out in China as well.
Yeah.
So
yeah.
they do need the feed if they were to start up. And I think they were already in process of startup, so they were still likely to feed. Maybe the ones that were supposed to come on in the second half of the year might have to delay if the econs are bad.
Yeah, exactly. Yeah, as Felipe was saying, maybe we could see some delays for the crackers that were expected to start in the very short term. But yeah, they should need a new big supplier to compensate the loss of US supply.
If we move on to ripple effect, Naphtha, what is the impact on Naphtha? What are you seeing, the immediate consequence and the sort of midterm view?
Yeah, well, our view was already weak on Naphtha. We were tracking ethylene, propylene prices. They did better than expected in Q1, but they were correcting since middle of February. So the petchem margins went trending lower, and right now this has been like a new bearish wave. So yeah, LPG has been bearish due to the weak petrochemical outlook, and Naphtha is feeling the same. And we have seen a very strong correction on cracks and time spreads. In time spreads, we were talking about like +8, +9 levels, and right now there is a big threat of contango during the summer months. So the market has changed in 1 month and a half, and this is going to keep being very bearish. On the flat price, we have seen a similar correction, not as big as LPG, that has dropped about 30%, but in Naphtha it has been 20% drop of the prompt flat price. But yeah, the main thing I would say is that it's very likely that we will see contango at some point in the coming months.
Well, which doesn't seem shocking, to be very honest. I don't know.
Not shocking, but it would be shocking if you were looking at the market 2 months ago, because the market was very tight in the prompt, and the spreads for summer were not even close to contango.
Yeah, fair enough. And so obviously then the next one is gasoline. We were talking last week that gas naphtha rallied, mainly completely irrelevant around tariffs and sanction. It was much more around just purely market dynamics, where naphtha was weakening and gasoline was pretty stable. So that has continued, I would imagine, that the gas naphtha has widened even more. What have you seen, and what do you think is the impact?
Yeah, I think the short-term impact is that the position of Europe as exporters has improved a lot, especially in the Atlantic basin. Gas naphtha has rallied, and the expectation for naphtha is weak. So we don't see a ceiling in the very short term. And we have another components like reformate, which have kept on a downtrend since the beginning of the year. So right now the blending opportunities are a lot, like the arbitrage of FARBOP is open. Also the IBOP blend, if I-10 blending it locally, it's also open. So the opportunities of blending in Europe have improved a lot during the last week or 10 days. And and another thing that we have seen is despite gas snap, despite the very strong uptrend in gas snap, the cash diff for the naphtha that goes to blending have rallied during the last week. Not a very big rally, but they have gained like $7-8 per metric ton in 1 week, which is exactly the opposite that has happened to petrochemical naphthas. We have right now discounts in Northwest Europe.
Naturally,
yeah.
Which makes sense, you want to compensate for, if the flat price drops by 20%, you want to compensate for those pockets of demands that are still there to be taken. But interestingly, what you're saying is that the component prices, despite, like reformat, alkylate, etc., despite the gas naphtha rally, they have stayed pretty much the same.
Exactly.
Now, there's some compensation of the cash diff of naphtha that, it doesn't look that positive because the cash diff, but as you said, the blend margins are very, very positive. Now, what that's telling me is that on a midterm perspective, there's a lot of flat price is quite low right now. Elasticity of demand for gasoline is actually, people are still going to drive. The outcome of this is not, Neil, you were talking about a COVID kind of shock in the market, but here it's not like you're forced to, stop working, you're forced to stay at home. You will be impacted in one way or another, but it's more of an uncertainty right now that is that is dominating the environment rather than an actual physical reality. What I'm trying to say here is that ultimately people will still drive, you will still have demand for gasoline, even potentially even more demand now that the flat price is so low. And therefore, if you can lock in these margins, you can buy these components, it seems like this is the right time to do it, because maybe you're not seeing people buying in advance because there's sort of like paralysis by analysis, or, everyone is sort of like, deer on headlights right now. But let's face it, gasoline seems like there's, it should not be affected by sanctions or tariffs in a major extent. You have very good margins right now. This is the time to lock them in.
I totally agree with that statement in terms of that's one of the differences, that the demand impact will be slow and steady, I presume, right? If the macro outlook continues to get worse, then what you'll see as with other recessions, the demand impact will just get slowly worse. And that's obviously a key difference to COVID, yeah, of course. And that's why I also think it's funny that diesel cracks are steady, but the naphtha market is sold off so much. Is that basically a kind of short-term opportunity for naphtha, right? Well, in the very prompt, is naphtha supposed to be this loose? Who knows? Maybe not.
Good point. Yeah. Well, again, it's so dependent on China. I mean, I would say that's the difference, if you want, is that it is heavily dependent on China, because China is now, I don't know. I mean, I don't have the stats, Jorge, you probably know better than I do, but they import quite a lot of naphtha, a big chunk of naphtha, LPG, etc. And if they don't know what they can produce, and that's the real deal, is that they have 100% tariffs, 35%, 25% of their demand is suddenly now stopped. See, what do you do with that?
Well, it is stopped, and it's also, it's not stopped, because I mean, ultimately the US consumer will bear the brunt of this thing, right? It depends on what your view of how healthy the US consumer is and how long they can take higher prices and all that kind of stuff. So it hasn't stopped trade overnight.
No, I'm talking about the production of petchems, if you want. If I'm a Chinese factory and suddenly I have no idea if I can sell to the US, I'm not going to be producing to the US. I'm not going to be producing that volume, if you want to. Well, you could, but then it just means that you're going to have to dump it somewhere else in a market that is oversupplied. You see, so if I was them, I would be like, you know what, I'm going to not buy my feedstock. I'm going to take 1, 2, 3 weeks to think about it, and then suddenly you do have a shock in demand for LPG and naphtha.
An upside shock, you mean?
Yes.
Later.
Yep.
Yeah.
Well, no, the other way. No. I mean, a shock in terms of zero demand. I'm like, you know what? I'm not going to buy for the next 3 weeks because I have no idea whether I want to produce, because I don't know if I can sell. You see?
Yeah. There is another point also on the naphtha market behind this bearishness in the market. That is the arc to Japan and Korea. They buy more from the West than China. China relies more on AG and Russia. But yeah, the market has been supported during Q1 because the arc has been very open to Japan and Korea for some part of for the last month and a half. And yeah, the main driver was gas diffs in Japan and Korea. They rallied a lot. They went from +5 to +20 in 3 weeks, and the arb was very open. And this has kept the market strong. Right now, we have seen also a reversal on this in the last week and a half. The gas diffs has collapsed in Japan and Korea. They have went to the previous levels of +5, +6. And the East West, it has rebounded during the last couple of seasons, but it lost like $5-6 per metric ton during the last month. So the arb right now is not working. It's not working, not from the US, not from Europe. So this has been also a very supportive factor during Q1 that now is not there. So yeah, I think that's one of the points why I think that we could see even lower levels on the naphtha market.
Okay, anything else to add on gasoline, or should we move on to distillates?
Yeah, maybe just a couple comments that we have seen in our tool regarding the competitiveness of different regions. Yeah, AG has become more competitive into Nigeria. Obviously, comparing an LR1 with a MR from ARA, that's something that we have talked in previous podcasts, but just to highlight this. And Singapore, due to lower freight, keeps being more competitive than AG into Pakistan and other switching outlets in the east. So we have that's dynamic in the west in the east. Sorry, after Mines West has widened over $6 per barrel.
I would assume that freight rates have come off generally. No, I mean there's a sort of like no or not. What have freight in general have done?
Yeah, TC2 as well has done on the gasoline market.
In a world with this theoretically less trade, I'm not susceptible to be long freight.
No, of course.
Yeah. Doesn't mean that I'm short, but you see what I mean? So
yeah, of course.
Have we seen that, whether it's gasoline, diesel, or anything like that, or not?
In gasoline, we have seen it in TC2 and in the rates out of Singapore, which makes sense with your statement. But yeah, of course, if we go to a world with less trade and more tariffs, that would be really bearish for freight in Q3, let's say.
Okay, moving on to distillates. Who wants to take over from here? Neil.
Yeah, I'll do it quickly because we're going on for 3/4 of an hour already, but yeah, we've been over some of the things. So cracks and spreads generally held up through this whole thing, as we've already said. In fact, this week you actually saw some spreads rise. So the heating oil spreads also on ice a little bit. The crack box is up, so that's the relative spreads against the crude. So it's all kind of surprising and at odds with the naphtha picture, let's say. Because, of course, diesel is one of the kind of canaries in the coal mine type thing for the health of global economy. But we've just said probably the demand impacts will be slow and steady and gradually build up over time. So nothing's really changed in the physical diesel market. And I just wanted to spend 2 or 3 minutes describing that I don't even think it's really time to short the diesel market yet. So the one thing is in Europe, all of the swing arbs, or the most important arbs, let's say, are now not open into Europe. So the swing diesel arbs out of the Middle East and India are now pointing east rather than west. And that's partly on what looks to be some kind of emergent tightness in Asia itself, which might well be to do with turnarounds, as they're peaking essentially in Asia. And the Gulf Coast MR arb into Europe is also closed, and they have better netbacks to Brazil, generally speaking. So from that perspective, the arb perspective into Europe, it looks mildly bullish even. And there's a couple of other things to point out there. There's probably a bit of a problem on the Rhine at the moment. So there's low water levels that tends to make things difficult for moving diesel from ARA upstream, if you like, inland, which eventually will be resolved. I mean, I'm not quite sure how that's affecting actual flows yet. Typically what happens is when water levels drop, you use up slack in the barge market because you essentially lower load rates. And first thing is that freight rates go up and then actual volumes drop. So that will eventually resolve. And yeah, I think the Asian tightness might have some legs, generally speaking, because there are turnarounds. Refining margins in Asia are not great, I would say. And there might well be some, let's say, hesitancy from Asian refiners to max out crude buying and max out crude runs going forward, even when they exit maintenance. and we see that Singapore distillate stocks have been drawing, and so to a certain extent they might need to drag out some of these ARB volumes from Africa and from Europe away from the Middle East instead of going to Europe. So I feel like it's not time to short diesel. Obviously this thing can change if the sentiment really starts to sour, but particularly from the European and Asian perspective, I don't really see any short-term weakness at the moment. And of course, Europe's also coming out of turnarounds. I don't think the European crude runs are showing signs of being particularly strong right now. So that's it, really.
Okay. What's next?
Crude, June.
Crude. So we talked a lot about flat price already. So maybe on the refining margin side, we are still seeing that it's quite firm, and crude spreads as well. So what is it telling us in terms of physical market versus perceptions? We are fundamentally supportive for margin still. Physical oil product demand is still there, maybe not a total plummet like what we saw in the COVID period. But we do have more crude oil than what the refineries need in each region right now, particularly in the east with OPEC plus supply coming on with the extra 411 KBD from May. And therefore, we are seeing crude premium correcting in order to incentivize refineries to run. And also, don't forget, we have the new refinery coming up, the Sinopec Zhenghai Zhejiang refinery, or rather it's not a new refinery, it's an expansion, 220 KBD likely in May. So where have we seen these bigger FOB losses this week? Mainly in the spot MEG. Strong OSP cuts from Saudi is likely going to nudge the Asian refiners to nominate more Saudi crude for their April loaders, and will reduce the need to buy incremental spot for May loaders. And with all the likelihood of weaker demand going forward and more OPEC supply, we have seen Murban premia have tumbled from the highs of $2.50 per barrel to now about $1.20. We also see possibly perceived lower threat of supply risks, where before, if we had lost Iranian and Venezuelan barrels due to the sanctions, then obviously the spot premium would be justified. But now that the tariffs, what's another 25% or another 50% to the 104% already in place to China. So we will likely see them take it anyway. So the loss of supply on these sour barrels will likely not be as severe as what we thought before. For the Brent Dubai EFS, right now it continues its downtrend. It's now about minus 10 cents where I last saw it. Most people will see this as an up signal to come more to the east. But at this point, because the MEG spot premium have corrected so much, it is making the Middle East grades the most competitive grade. Even CPC, where is usually seen as very cheap now, lending to the east. But when we look at the yield side, it's Naphtha rich. And we just talked about Naphtha being the weak link here. It looks actually undesirable from a margin point of view comparing to Murban. And we go now, the other loser in the premium is Johan Sverdrup. The FOB declines have been fairly extreme. We saw an overhang of April barrels and that limited buying in Europe. Very limited up demand and possibly competition coming up from Johan Castberg, which is a 34 API stream. But yeah, it is a big competition. Interestingly, we just heard as well, China rumored to have bought 1 VLCC worth of April loading Johan Sverdrup, which should be against the Oman competition. So the up is indeed starting to open. And interesting to see the margins improve over, for example, WTI VLCC deliveries into Northwest Europe. Given that there's increased medium crude availability, we should see that the light medium differentials should widen. At this point of time, 40s and North Sea sweet lights, including the WTI CIF market, looks overly strong. So we anticipate some correction. We might see the Black Sea and the Med crudes weaken a little bit from here. Obviously, there's news that CPC, SPNs will be allowed to operate fully in the coming days. And with FOBs looking like a race to the bottom, from a refinery point of view, they will likely take their time, hold back on the buying a little bit, and choose the best crude available for this trading window. And for those who already bought or going to buy, I would think that they want to hedge it quickly because the demand side of the product's view might very quickly change. So any decision to buy should be hedged carefully.
Thanks for that. This reminds me, Neil, last week when we before the tariffs, the big talk was, CPC, the SPM. So that was sort of like a bullish sentiment that has been resolved. Is that what you're saying, June, Neil?
Yeah, I mean, the headline is that the inspections are over and the SPMs will be allowed to load. I don't think that they're both operational yet, but it seems like the risk is over from a supply perspective. Yeah.
Okay. And the other one was obviously the the Northwest Europe market. There was, what was it, the CFDs, or what was the other?
Basically, yeah, CFDs, DFLs. Those are still really strong.
They're still strong, no? Yeah.
They did correct, and then they went back up to $1.90 yesterday, the day before, and then now I think they're back at 150. I need to check again. It keeps changing, but they're extremely strong still. I'm not quite sure I fully understand why. I'm still short, let's say.
Maybe the next month, not this.
Yeah.
Maybe there's a reversal. Okay, so that story is still there. That's sort of the only sort of bullish sign out there with cash dips coming off. That's surprising indeed when you have a global cash dip environment telling you a story, and Northwest Europe is a different one. Yeah, we might see a reversal in the next month. Yeah, for sure. Okay, so how do we summarize all of this? If we need to provide some sort of clarity. Who wants to give it a shot at summarizing? Because again, I can only assume that everyone right now is like a deer in front of headlights. Not everyone, but there's some people thriving, but a lot of people sort of like, what the heck is going on? So if you had to provide a certain level of clarity in terms of the short term, what would that be?
I can summarize. Maybe we can summarize with a couple of suggestions. So would you be long margins, generally speaking, in the short term? I think going through the products on balance, probably yes. And from the crude side, it seems like the physical market is slowly weakening, which is also going in the same direction almost. Is that a fair statement?
I agree, especially with the flat price where it is, and as you said, that the impact on demand will be gradual and not necessarily a big shock. I think that's a good way of looking at it. Yeah.
I still am confused on the Naphtha market. I mean, we can talk afterwards, but and then sort of clear it up next week. But maybe Naphtha's the exception, but the other products seem unaffected. Possibly they get a demand bump, as you said, Felipe. Naphtha has other, let's say, balancing factors, right? So assume that the simple margins will look less and less attractive if Naphtha continues to be weak. So that's one thing. And there's supply side factors as well. So one of the ones that always comes to mind on the US side is the fact that there's all this sort of C5 and light production in the US that comes out of the crude stream when cracks are strong, and when Naphtha cracks are very weak, there's an incentive to shove them back into the crude stream again. And that is something that the market tends to talk about when there's big swings in Naphtha cracks. So that's another thing that could incrementally take, a couple hundred KBD out of the Naphtha market overall.
I think we didn't talk about fuel oil, but actually what we are seeing is fuel oil was still strong. The fuel crack is the real performer in this last week. So even if Naphtha was coming off, the overall refining margin was kind of kept steady with fuel oil coming up to offset that position. So the long margin for refinery is actually, is directionally correct. And why we are seeing the high sulfur fuel oil crack is strong is likely due to the seasonal summer burn requirement. They are now in the period where they are building.
So that is
I don't think that demand will change regardless of what happens economically.
True. Okay, and in the midterm, yes, I think that in the midterm we need to wait and see. The macro still is dominating. But I, as I said, the first thing is I'm shocked that the spreads, the cracks haven't really moved that much in an environment where, in theory, you should have a lot of panic movements and volatility and all that. That hasn't really changed that much. So it's an indicator that people are still waiting and seeing, and perhaps there's not a lot of activity. We maybe need to look at volume, but I would be surprised that there's a lot of volume going on and everyone is just waiting, because ultimately it is not affecting oil directly, in the sense that its tariffs are not impacting oil in the US. The only one is China, and the demand impact can be as bullish because of low prices as bearish in terms of lesser activity, this recession and the impact of recession, etc., which again is wait and see. But okay, I think there's other than the Naphtha story or the LPG story, I would say everything else seems to be wait and see.
Yeah.
Okay, well, let's wrap it up here. Hopefully, everyone gets a little bit more clarity, or maybe not clarity, but less stress, if you want. I would say it's like actually the impact, other than flat price, is not necessarily that obvious right now, and in any kind of different scenarios, not necessarily going to have a dramatic impact in the short term. Well, let's see. Let's not get ahead of ourselves. Let's see what Europe responds, or China, etc.
Yeah.
Anyway, thanks a lot, guys. I'll see you next week.
Thanks.
Cheers.
Thank you.
Bye-bye.
Thank you.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.